Look, right now, investors have borrowed more money to buy stocks than at any point in history, over $900 billion in margin debt. That's more than during the dot-com bubble, more than before the 2008 crash. And history shows every single time margin debt hits a record, a crash follows. Chapter: Introduction. Hey everyone, welcome back. Today we're diving into something that doesn't make headlines but should scare you more than any Fed announcement: margin debt. This is money borrowed from brokers to buy stocks, and it's exploded to levels we've never seen before. Chapter: The data. Let's look at the numbers. Data_card, total margin debt $912 billion, plus 18% YOY, margin debt just hit an all-time high, up 18% from last year. For comparison, Data_card, margin debt March 2000, $278 billion at peak before dot-com crash. Right before the dot-com crash, margin debt peaked, then the Nasdaq lost 78% of its value. Data_card, margin debt July 2007, $381 billion, peak before 2008 crash, before the 2008 financial crisis, same pattern. Margin debt peaked, then markets collapsed over 50%. Today's number dwarfs both of those. Data_card, S&P 500 PE ratio 28.5x, historical average 16x, and this is happening while valuations are already stretched. The S&P 500 trades at 28.5 times earnings versus a historical average of 16. Chapter: Analysis. Here's why this matters to you, even if you never use margin. When investors borrow to buy stocks, it amplifies gains on the way up, but it turbocharges losses on the way down. If stocks drop just 20 to 25%, brokers issue margin calls, forcing investors to sell not because they want to, but because they have to. That forced selling creates a cascade: prices fall, more margin calls trigger more forced selling. This exact mechanism turned corrections into crashes in 1929, 2000, and 2008. Data_card, 1929 crash impact, minus 89%, peak to trough, margin fueled. The 1929 crash, largely fueled by margin debt, wiped out 89% of market value. We're not saying that's happening again, but the fuel is sitting right there. Chapter: What's next? So what should you watch? Keep an eye on FINRA's monthly margin debt reports. Rapid unwinding is often the first sign of forced selling. Watch the VIX and credit spreads for stress signals. If you use margin yourself, this is the time to reduce leverage, not add to it. Cash and quality assets tend to outperform during deleveraging events. Diversification matters more than ever when leverage this extreme sits in the system. CTA. This isn't fear-mongering, it's math and history. Record margin debt has preceded every major crash in modern market history. Drop a comment. Are you worried about margin debt levels, or do you think this time is different? Hit like if this opened your eyes, and subscribe so you don't miss our next deep dive into what's really moving markets.